The premium chart breakout strategy is a popular approach. Many traders use it. What is it exactly? It is about identifying key price levels on a chart. These levels are typically support or resistance. When the price decisively moves beyond these levels, a breakout occurs. This often signals the start of a new trend, or a continuation of the existing one. The strategy aims to capture the profits from these strong movements. It is based on the idea that these breakouts can lead to significant price changes. Understanding this can give you a clear plan. This strategy is rooted in observing market behavior and price action. Why is this strategy so important for traders? It provides a systematic way to enter the market. You are not just guessing where the price will go. Instead, you are waiting for the market to show its hand. When a breakout happens, it suggests a shift in the balance between buyers and sellers. This shift can lead to sustained price movements. For traders, this means an opportunity to enter with a higher probability of success. It helps to filter out market noise. It focuses your attention on significant price events. This clarity can greatly improve trading decisions. How does this strategy help in spotting potentially big moves? Breakouts often act like a dam bursting. Pressure builds up behind a support or resistance level. Buyers and sellers battle it out. When one side finally overcomes the other, the price breaks through. This release of pressure can result in a powerful and rapid price move. The premium chart breakout strategy is designed to identify these points. It allows traders to enter the market just as this momentum is unleashed. Being able to catch these moves early can lead to substantial profits. It's about being ready for that explosive shift. So, we are setting the foundation for understanding this powerful strategy. It is more than just drawing lines on a chart. It involves understanding market psychology and order flow. When many market participants watch the same key levels, their collective actions can make breakouts more potent. This section aims to introduce the core idea. It will prepare you for the details that follow. Learning this strategy can equip you with a valuable tool. It can help you navigate the markets with more confidence. Get ready to explore how you can master these chart breakouts. What exactly are breakout levels? These are critical price zones. We call them support and resistance. Support is a price level where buying interest is strong enough to overcome selling pressure. Prices tend to bounce up from support. Resistance is the opposite. It's a price level where selling pressure overcomes buying interest. Prices often turn down from resistance. These levels are formed by previous highs and lows. The more times a price touches and reverses from a level, the more significant that level becomes. A decisive breakthrough such a level is what we call a breakout. Now let's talk about volume. Why is volume a crucial piece of the puzzle? Volume measures the number of shares or contracts traded during a specific period. When a breakout occurs, you want to see a surge in volume. High volume confirms the strength of the breakout. It shows that there is strong conviction and participation behind the move. Many traders are supporting this new price direction. A breakout on low volume is less reliable. It might be a false signal, often called a fake out. So, always look for volume confirmation. It acts like a lie detector for price moves. What about market trends? The trend is the general direction the market is heading. Is it going up, uptrend? Is it going down, downtrend? Or is it moving sideways, range-bound? Trading breakouts in the direction of the prevailing market trend is generally a higher probability approach. This is known as trading with the trend. If the market is in a strong uptrend, a breakout above a resistance level is more likely to succeed. Conversely, in a downtrend, a breakout below support is favored. The saying "the trend is your friend" holds true here. Aligning with the trend can improve your odds. How do these concepts, breakout levels, volume, and trends, work together? They form a powerful combination. Imagine the market is in an established uptrend. Price then consolidates below a clear resistance level. Suddenly, price breaks above this resistance. At the same time, you observe a significant spike in trading volume. This is a textbook breakout scenario. The trend provides the underlying momentum. The breakout from the level signals the immediate trigger. And the high volume confirms the conviction behind the move. When all these elements align, the probability of a successful trade increases substantially. This synergy is what you look for. So, how do you actually identify a potential breakout setup? First, you need to scan your charts. Look for well-defined horizontal support or resistance levels. These are areas where price has reacted multiple times in the past. Draw these lines clearly. Then, observe if the price is consolidating near one of these levels. Consolidation phases like ranges or chart patterns such as triangles and flags often precede breakouts. The longer the price coils or tightens near a level, the more energy it might build. This energy can lead to a more explosive move. Patience is your ally here. Wait for the setup to fully form. Once you've identified a potential breakout, what are the next steps? This involves your entry, stop loss, and take profit. For an entry, it's often wise to wait for the price to close decisively beyond the breakout level. For example, if a candle closes above resistance, that's a common entry signal. Don't rush in the moment it pierces the level. This helps avoid false breakouts. Your stop loss should be placed to limit potential losses. For a long trade, buying, place it just below the broken resistance level. For a short trade, selling, place it just above the broken support. For take profit, you can use a fixed risk-reward ratio like 1:2 or 1:3, or look for the next significant chart level. If you are a beginner, here is a crucial tip. Start with paper trading. What does this mean? It means using a demo account with virtual money. Do not risk your hard-earned capital immediately. Use the demo account to practice identifying breakout setups. Practice executing your entries and exits according to your plan. See how your trades play out. This allows you to get a feel for the strategy. You can learn from any mistakes without any real financial consequences. Paper trading helps build your confidence and discipline before you trade live. It's an essential step in your learning curve. Another vital tip for newcomers is to cultivate patience and always seek confirmation. Trading breakouts can be exciting, but don't let emotions drive your decisions. Wait patiently for a clear breakout to occur. Don't try to anticipate it or jump in too early. Look for that strong candle close beyond the level, and, as discussed, check for increased volume to confirm the move's strength. Sometimes, after a breakout, the price will pull back to retest the broken level. This retest can offer a second, often safer entry opportunity. Patience prevents overtrading and confirmation helps filter out weaker signals. Let's quickly recap the core idea. The premium chart breakout strategy provides a structured way to trade. It is based on identifying significant price levels and acting when these levels are breached with conviction. This approach moves you away from impulsive, emotion-driven trading. Instead, you rely on observable market behavior and predefined rules. This clarity and structure are incredibly valuable for any trader. It helps in maintaining discipline, which is a cornerstone of consistent trading. Many successful traders build their careers on such systematic approaches. It offers a clear path. One of the most significant benefits of this strategy is its inherent risk management. When you enter a breakout trade, you know precisely where your invalidation point is. This is the level where you admit the trade isn't working out. Your stop loss is placed just beyond this point. This clearly defines your maximum risk for that particular trade. Simultaneously, you can set realistic profit targets. This allows you to aim for trades that offer a favorable risk-to-reward ratio. For instance, you might risk $100 to potentially make $200 or $300. Consistently applying good risk management is absolutely essential for long-term survival and profitability in trading. Furthermore, this strategy offers the potential to catch significant market moves. Breakouts often mark the beginning of new, strong trends, or the acceleration of existing ones. By correctly identifying and entering these breakouts, you position yourself to participate in these extended price swings. Imagine being able to enter a new trend near its very start. This is precisely what the breakout strategy aims to achieve. You are essentially trying to capture the momentum as it unfolds. Being on the right side of such powerful market shifts can lead to substantial profits over time. It's about capturing that thrust. Mastering the premium chart. Breakout strategy is a journey. It requires consistent practice, diligent observation, and a commitment to continuous learning. Not every breakout will be successful. False breakouts are a reality. That's why risk management is so important. Review your trades regularly. Analyze what worked well and what didn't. Adapt your approach as you gain more experience. The financial markets are dynamic, but the underlying principles of supply, demand, and price action that drive breakouts tend to remain consistent. With dedication and disciplined application, this strategy can become an invaluable component of your trading toolkit, paving the way for potential success.